Ladies and gentlemen, today we face a financial story that could reshape the global bond market. Japan, the world's largest holder of U.S. Treasuries, now controls a staggering $1 trillion in these assets. But here's the hook: a single decision from the Bank of Japan, yes, that BOJ meeting this week, could trigger shocks across the bond markets and ripple through the entire U.S. economy. Imagine a market that has long been considered stable suddenly wobbling because the largest creditor is reconsidering its stance. That's not just theory, that's a looming reality. For decades, Japan has quietly supported U.S. debt, helping keep interest rates low and financing the American government at historically cheap levels. But rising domestic pressures, inflationary trends, and political debates within Japan are forcing policymakers to reconsider their strategy. If the BOJ signals a shift, even a minor one, the consequences for U.S. Treasuries could be dramatic. Yields could spike, borrowing costs could surge, and investors may scramble for safety. This isn't speculation. This is the reality of global interdependence in the modern financial system. Now, let me break it down. Why does this matter to you, your savings, and global markets? First, bond yields are the backbone of interest rates everywhere, from mortgages to corporate loans. A sudden move by Japan could increase U.S. borrowing costs almost overnight. Second, the ripple effect could extend to equities, commodities, and even emerging market debt. Investors hate uncertainty, and the BOJ holds a giant lever over this uncertainty. And finally, this scenario underscores the fragile dance between geopolitics and finance. What Japan does isn't just about Tokyo. It's about Wall Street, Main Street, and every market participant watching carefully. But here's the critical point. The hook I want to leave you with: history tells us that markets often underestimate these shocks until they happen. The U.S.-Japan bond relationship is no longer just a number on a balance sheet, it's a potential catalyst for market disruption. And while some analysts dismiss the risk, the fact remains $1 trillion is not something that can be shifted without consequences. Every word, every hint from the BOJ this week could move trillions of dollars globally. Japan's holding of $1 trillion in U.S. Treasuries is more than just a statistic. It represents one of the most powerful levers in the global financial system. For decades, Japan has been quietly and consistently purchasing U.S. debt, providing stability to the Treasury market and keeping American borrowing costs remarkably low. But consider this: $1 trillion is not just a number. It is the equivalent of a financial sword hanging over the bond market, capable of shifting yields, influencing investor behavior, and even affecting the U.S. dollar's value. Few outside financial circles fully appreciate the sheer magnitude of this position. But the reality is stark. Japan's Treasury holdings make it a central player in the global monetary system. The dynamics behind Japan's accumulation of U.S. debt are deeply rooted in its domestic economy. With years of low growth, an aging population, and persistent deflationary pressures, Japanese policymakers have relied on safe, income-generating assets abroad. U.S. Treasuries have historically provided this combination: liquidity, reliability, and steady returns. But here's the twist: the very size of Japan's holdings gives it leverage that no ordinary investor possesses. Even small adjustments in their Treasury purchases or sales could produce outsized effects in yields, creating waves of volatility that extend far beyond Tokyo or Washington. Imagine the scenario: a subtle shift in the Bank of Japan's messaging, a hint that they might scale back Treasury purchases, and suddenly investors around the world are forced to recalibrate risk, repricing bonds, adjusting portfolios, and scrambling for safety. The $1 trillion is not just sitting idle, it is an active instrument of influence, and the market knows it. Traders, analysts, and policymakers constantly watch Japan's moves, because history has shown that underestimating this player can be costly. What makes this even more compelling is the psychological element. Markets react not just to actions, but to expectations. A single signal from Japan can trigger a chain reaction, sending yields higher and shaking confidence in otherwise stable financial instruments. This is why understanding the scale and implications of Japan's Treasury holdings is critical. It is not merely a backdrop to global finance. It is a live, dynamic force capable of reshaping investment strategies, impacting economic growth, and influencing the cost of capital for millions of Americans. In short, Japan's $1 trillion Treasury position is the hidden engine behind some of the most important financial decisions worldwide, and ignoring it is no longer an option. The risk of a policy shift by the Bank of Japan has become one of the most closely watched developments in global finance. and for good reason. The BOJ has long maintained an accommodative stance, supporting not only domestic economic growth, but also indirectly stabilizing U.S. Treasury markets through its consistent purchases. But the question on every investor's mind is this: what happens if that policy changes? Even a minor adjustment in the BOJ's approach could send shockwaves across bond markets, producing a cascade of consequences that ripple far beyond Tokyo. Consider this scenario: market participants, conditioned for years of predictable behavior, suddenly confront uncertainty. The mere hint of a tightening stance or a reduction in Treasury purchases could trigger sharp repricing of bonds, a spike in yields, and a surge in volatility that leaves investors scrambling to reposition their portfolios. The mechanics behind this are both straightforward and startling. U.S. Treasuries are widely regarded as the bedrock of the global fixed income market, and foreign central banks, particularly Japan, play an outsized role in determining their stability. When the BOJ signals an intention to slow or reverse its purchases, it is not merely a domestic monetary decision. It becomes an international market event. Traders and institutions that have long relied on Japanese buying as a stabilizing force would be forced to react, potentially amplifying moves in yields and creating a domino effect across other markets, from corporate bonds to equities and beyond. What makes this situation particularly tense is the psychological element embedded in market behavior. Investors are highly sensitive to signals and expectations. Even without an actual policy change, a hint or tone from the BOJ could catalyze large-scale repositioning, generating volatility that is disproportionate to the actual adjustment. The risk is compounded by the sheer scale of Japan's holdings, over $1 trillion in U.S. debt. Small shifts, when magnified by the expectations of global investors, have the power to move markets in ways that few anticipate until they are already underway. The stakes are not theoretical. Rising yields driven by a policy pivot could increase borrowing costs across the U.S. economy, affecting government debt, mortgages, and corporate financing. Internationally, emerging markets and currency markets are highly sensitive to changes in Treasury yields, meaning a BOJ signal could cascade into a multi-layered global impact. The world has come to rely on the predictability of central bank actions, but the BOJ's next move could remind markets just how quickly that assumption can be challenged, turning stability into uncertainty almost overnight. Rising U.S. Treasury yields resulting from shifts in Japan's purchasing behavior would have immediate and far-reaching implications for borrowing costs across the American economy. Treasuries serve as the benchmark for virtually every form of credit, from government debt to corporate loans, mortgages, and consumer financing. When yields climb, the cost of borrowing rises in tandem, and that ripple is felt by households, businesses, and government agencies alike. Imagine mortgage rates suddenly inching higher because of a subtle signal from the Bank of Japan. What seemed like a stable housing market could face sudden strain, forcing families to rethink major financial decisions and businesses to reconsider expansion plans. For the U.S. government, higher yields translate directly into increased interest payments on an already massive debt load. Every percentage point increase in Treasury yields can add billions to annual debt servicing costs, straining fiscal budgets and potentially forcing difficult policy decisions. The delicate balance between government spending, taxation, and borrowing could be disrupted, impacting not only the economy but also investor confidence in U.S. debt as a safe haven. Even the perception of instability can trigger large-scale portfolio shifts as institutional investors adjust for higher risk and repricing. Corporate America would feel the effects almost immediately. Higher Treasury yields set the baseline for corporate bond rates, meaning that companies seeking financing for expansion, acquisitions, or capital improvements would face steeper costs. This could slow investment, dampen hiring, and reduce overall economic momentum. For consumers, the impact is personal and tangible. Credit card rates, auto loans, and student loans are often tied to Treasury benchmarks. A move by Japan that nudges yields higher is not abstract. It affects monthly payments, disposable income, and consumer confidence. The market psychology element further magnifies these risks. Investors often respond to expectations rather than actual events. The mere anticipation of a change in Japanese Treasury demand can spark preemptive selling, pushing yields even higher before any concrete action occurs. This self-reinforcing cycle can exacerbate market volatility and create a sense of urgency, forcing both domestic and international investors to reposition portfolios in real time. In a globalized financial system, The US cannot operate in isolation. Japan's $1 trillion stake is a lever with global consequences. Rising yields triggered by a BOJ signal are not a local phenomenon. They would cascade across markets, increasing borrowing costs worldwide and testing the resilience of economic systems that have long relied on predictable Treasury behavior. The interconnectedness of these markets ensures that no one is immune from the consequences, highlighting the high stakes and even seemingly small central bank decisions. A shift in Japan's Treasury holdings would not just affect U.S. borrowing costs, it would reverberate across global financial markets, triggering a complex chain reaction that few fully anticipate. The interconnectedness of today's financial system means that bond yields, equity prices, commodity valuations, and emerging market debt are all sensitive to movements in the U.S. Treasury market. When Japan, the largest foreign holder of treasuries, signals a change in behavior, the world pays attention. Investors, hedge funds, and central banks monitor these positions closely, knowing that even subtle adjustments can create turbulence far beyond Tokyo or New York. Consider equities, for example. Rising treasury yields often put pressure on stock valuations, particularly for high growth sectors that rely heavily on cheap capital. As borrowing costs increase, future earnings are discounted at higher rates, making companies appear less valuable. Investors who have grown accustomed to stable rates may react swiftly, selling positions and driving market volatility. The same principle applies to commodities. Gold, oil, and industrial metals often respond to shifts in bond yields as investors adjust for changes in interest rates, inflation expectations, and currency fluctuations. Even a small move in treasury yields can spark outsized reactions in these markets, creating a domino effect that touches multiple asset classes. Emerging markets are particularly vulnerable. Many countries rely on US dollar-denominated debt, and rising treasury yields increase their borrowing costs and strain fiscal stability. Investors may pull capital from these economies in search of safer returns, exacerbating volatility and potentially triggering currency depreciation. A decision by the Bank of Japan, therefore, is not just a local or bilateral matter, it is a global financial event with cascading consequences. The psychological impact on markets cannot be overstated. The mere anticipation of a Japanese policy shift can trigger preemptive moves as global investors adjust positions to hedge against potential risk. This amplifies the effect, turning a single decision into a worldwide market signal. The stakes are heightened by the size of Japan's holdings. $1 trillion is not a sum that can be absorbed quietly. It is a force multiplier, capable of influencing global liquidity, shaping investment strategies, and redefining risk assessments in real time. Understanding this dynamic is crucial for anyone engaged in financial markets. The world has become accustomed to a relatively stable U.S. Treasury market, underpinned by predictable foreign demand. But that stability is conditional, and Japan's decisions highlight just how fragile the equilibrium can be. When the BOJ moves, the ripples are felt everywhere, from the trading floors of Manhattan to emerging market capitals across Asia, Africa, and Latin America, underscoring the profound global impact of a single nation's central bank policy. Investor uncertainty and market volatility are natural consequences when a major player like Japan holds $1 trillion in U.S. Treasuries and signals even the slightest policy shift. Financial markets thrive on predictability, and the stability of U.S. Treasury yields has long been underpinned by consistent foreign demand, particularly from Japan. When that certainty is called into question, investors respond quickly, often in ways that amplify market movements far beyond the initial event. The mere hint of reduced Treasury purchases or a policy pivot by the Bank of Japan can trigger widespread portfolio adjustments, with institutional investors, hedge funds, and sovereign wealth funds repositioning assets to manage risk. This preemptive behavior transforms potential volatility into actual volatility, creating a self-reinforcing cycle that can ripple through global financial systems. The psychology of markets is as important as the fundamentals. Traders are constantly analyzing signals, speeches, and subtle changes in central bank communication. A cautious tone from the BOJ can lead to significant sell-offs in treasuries, pushing yields higher and forcing other market participants to react in kind. This feedback loop magnifies the initial impact, transforming what might have been a contained adjustment into a market-wide event. Volatility then spreads across equities, commodities, and currencies because investors are interconnected and sensitive to shifts in risk and liquidity. The scale of Japan's holdings adds a layer of tension. When $1 trillion is at stake, even small adjustments carry outsized consequences. Uncertainty is particularly impactful because it affects decision-making in real time. Fund managers may delay investments, banks may tighten lending, and corporations may reconsider capital expenditures, all in anticipation of a potentially more turbulent market. Retail investors, often less equipped to hedge risk, may react emotionally, further exacerbating short-term volatility. The combination of uncertainty, scale, and speed makes the market environment extremely sensitive to Japan's policy signals. Emerging markets also experience heightened sensitivity. Capital flows are closely linked to U.S. Treasury yields, and any sudden spike can prompt outflows, currency depreciation, and tighter financing conditions. Global investors are acutely aware that Japan's decisions are not isolated. They are catalysts capable of triggering chain reactions that cross borders, asset classes, and investment strategies. In a world where speed, leverage, and interconnectedness dominate, uncertainty in one corner of the financial system quickly becomes a global phenomenon. Japan's domestic economic policies and political decisions are no longer contained within its own borders. They have become critical variables in the stability of the global financial system. The Bank of Japan's actions are shaped by a combination of inflationary pressures, demographic challenges, and political debates, yet their impact extends far beyond Tokyo. Every policy signal, every shift in Treasury purchases, has the potential to alter investor behavior, market liquidity, and global confidence in U.S. debt. The reality is stark in an interconnected financial world. Domestic choices in one country can generate seismic effects internationally, and Japan's $101 trillion stake in Treasuries ensures that these effects are magnified. Consider the political dimension. Policymakers in Japan face competing priorities: stimulating domestic growth, managing an aging population, and maintaining fiscal sustainability. These pressures can lead to debates about reducing foreign debt exposure, adjusting monetary policy, or implementing unconventional strategies. While these decisions are rooted in domestic concerns, global markets interpret them as potential risk factors for U.S. Treasuries. Traders and investors monitor every nuance, aware that Japan's policy path could influence interest rates, borrowing costs, and asset valuations worldwide. The magnitude of these holdings transforms routine policy discussions into market-moving events. The demographic challenge also plays a critical role. An aging population increases Japan's domestic spending needs, prompting potential relocations of foreign assets. Shifts in Treasury demand driven by demographic pressures are subtle but potent, as they can alter yield curves and capital flows in ways that few anticipate. Financial markets, which rely on predictable demand for U.S. debt, are particularly sensitive to these shifts. Even a small adjustment, amplified by global trading systems and algorithmic strategies, can cascade into significant market movements. Inflationary pressures further complicate the equation. Japan's long battle with low inflation has shaped its approach to monetary policy, yet recent global inflation trends are forcing reevaluations. Central bank decisions to tighten or loosen policy can directly impact Treasury purchases, creating uncertainty for the U.S. bond market. Investors, aware of the scale and interconnectedness of Japan's holdings, respond preemptively, adjusting portfolios, hedging risks, and sometimes triggering volatility before any actual policy change occurs. The overarching lesson is that Japan's domestic economic and political considerations cannot be viewed in isolation. They have global implications, particularly for markets reliant on stable U.S. Treasury demand. Every decision, every debate, every policy signal becomes a factor that investors, analysts, and policymakers around the world must weigh carefully. The combination of scale, timing, and interdependence ensures that Japan's internal choices are a critical force shaping the trajectory of global finance. In closing, the takeaway is simple yet profound. The upcoming BOJ meeting is more than a routine policy session. It's a potential turning point for the global financial system. For investors, policymakers, and everyday citizens, staying informed is no longer optional. It is essential. The United States, Japan, and indeed the world are on the cusp of a moment where a single decision could redefine markets. Watch closely, because the tremors from Tokyo could soon reach your doorstep.